The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to today's NOVA presentation, 50 Years of ERISA, a Retrospective with Craig Hoffman. Before we get started, I'd like to point out the panel on the top right-hand corner of your computer screen. You're going to see a drop-down section for chat. This is where you will enter in any questions you may have for Craig. Feel free to submit your questions at any time. Keep in mind the Q&A portion of the session will be held at the end. If time runs out and you have questions, please send them to our email address, webinars@nova401k.com, and we can go ahead and forward that over to Craig. Right below chat, you're also going to see a handouts drop down. Here you will be able to download today's material in PDF form. If you are unable to view or click on the handout, you can go ahead and send us an email and we can provide that for you in PDF form. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates. Thank you so much for joining us today. I would now like to introduce Nova's attorney and senior consultant, Craig Hoffman.
Thank you, Yvette. Hello, everybody. Good afternoon to those where it's afternoon. Good morning to those where it's still morning. And welcome to 50 Years of ERISA, a retrospective. Now, I've been doing this stuff, I was just thinking 43 years, so it hasn't been all 50 years have been part of my life as a professional, but I've been through a lot of it, and this is a fun session. I've done it before. Some of you may have heard it over time, but it's fun to look back. My goal is to try and bring some of the history of ERISA to light, why we ended up where we are with some of the rules we have, and hopefully you'll find it interesting and entertaining. Here's the disclaimer. This is really not going to be much legal or tax advice in this session anyhow, but just in case, find your own attorney, not me. If you need CPA credit, this is Nova's provider number. I know it works in Texas. I'm not sure around the rest of the country, but you should be able to get CPA credit for this as well. As I said, I've been doing this now 40 odd years, and I've had the pleasure of being involved in a lot of these changes as they came about. It's been a career I certainly didn't expect when I was in high school that one day, gosh, I hope I grow up to be a pension lawyer, but here I am. So that's me. And there's, as others who have seen, is a latest shot of Fergie, my 2.5-year-old mini doodle. She's a great dog, and I just can't help but show her off. We're going to the dog park after I finish today, so she'll be happy to hear when this ends. Moving on, so you can see the agenda. I'm basically doing it decade by decade and trying to highlight what happened during those 10-year periods. Some of it bleeds over from one decade to another, but I think it gives us a framework to go back through the last 50 years. And so it began in the 70s, 1974. I was a junior in college, and the only thing I cared about is which bar was having nickel beer night that night. But politics was ongoing. 74 was the year Nixon resigned and Gerald Ford was president. Home mortgage rates were 7.3%.
Craig, your sound cut off. Craig, can you hear me?
Rising to a high of 18.1. So I kind of laugh when people get upset about it. They bought was an and I have to. So what happened on Labor Day? Signed ERISA in front of a packed crowd of men. You notice this is 1974. There is not a single woman senator or congressperson to join in the signing ceremony. Thankfully, we've come a long way since then, but this was the 70s. Now, the bill itself was, as you can see, very bipartisan, passed unanimously in the Senate, and two stalwarts, for whatever reason, voted against it in the House. But these were the days when Congress worked in a bipartisan fashion, and frankly, historically, over the last 50 years, that has traditionally been the case with pension laws. But ERISA was focused primarily on DB plans because they were the primary plan in the 70s, and problems with DB plans funding. The iconic case for why we needed ERISA was the Studebaker Car Company, which many of you may never have heard of a Studebaker, but nevertheless, it went bankrupt in the 60s and had an underfunded defined benefit plan, resulting in many thousands of their workers being cut short or not getting any defined benefit pension that they had been promised. So ERISA focused on funding, it focused on coverage, fairness, and who gets covered, vesting rules. The pre-ERISA plan, some plans had provisions you didn't invest in your benefit until normal retirement age. So there was a lot going on, and it added government oversight. And what it also did for the first time is add a labor law aspect to regulating pension systems. Prior to that, qualified retirement plans were only regulated, if you will, by the rules that they had to meet in order to be qualified for favorable tax treatment. Well, many of those rules changed as a result of ERISA, but mirror images of them were also made part of the labor laws, with potential civil penalties and even criminal penalties above and beyond losing the tax benefits of being a qualified plan. And so ERISA still remains the basic structure on which our pension laws are based. Noteworthy after 74 was the 1978 Revenue Act, which added to the code Section 401k. It's hard to believe there was ever an Internal Revenue Code that didn't have Section 401k. But it was meant to simply codify an exception to the normal rules on constructive receipt, where if you have the right to get the money that you have earned, you can't turn your back on it and have it contributed to a plan and avoid taxation. Instead, we had a limited exemption, if you will, to the constructive receipt rules for the so-called cash or deferred election, whereby a participant could forego current compensation and have it contributed to the plan on their behalf. It became effective in 1980, so it's now been 44 years, and few in Congress envisioned how that would become the primary retirement vehicle for Americans today. And just, I'm sure not many remember, but the original 401k, we had the 1/3, 2/3 test. That was a lot of fun when you had a plan where you had a bunch of doctors, and some of the doctors were in the lower 2/3, but I digress. So that was the 70s, really, it was ERISA. But then we hit the 80s, and we started a path that's pretty much continued over the last 40 years, namely continually modifying the pension laws for either policy reasons or many times just to raise revenue. And in fact, those early laws in the 80s, a big part of that was revenue raising. There were three. TEFRA, they're grouped together because they were right on top of each other, and the IRS ultimately grouped them together for a remedial amendment period that covered all three laws. Those laws are still very, the provisions in TEFRA, DEFRA, and REA are still very much with us in our current applicable laws. TEFRA was the Tax Equity and Fiscal Responsibility Act. Again, fiscal responsibility. Congress was trying to, in many ways, reduce the deficit But a part of that were some of the pension law changes, and in particular, noteworthy to us today, the top-heavy rules were added to TEFRA at the last moment. Literally, I believe, when the chairman's mark was given, was put before the House, Charlie Rangel, who was then a Democrat, chairman of the House Ways and Means Committee, put in a provision, put in these top-heavy rules. And what they were and still are special qualification requirements that must be satisfied if the plan primarily benefits the big kahunas, or as we now call them, the key employees. Owners and officers are the major two categories of key employees. Prior to TEFRA, we had special rules that applied to plans adopted by entities that were not incorporated, either self-employed individuals or partnerships. In the 60s, the early 60s, they weren't eligible to have a retirement plan. Later in the mid-60s, Congressman Keogh, in a bill known as H.R. 10, enacted rules that would allow self-employed to have retirement plans, but subject to a number of restrictions. Well, the TEFRA top-heavy rules were meant to do away with restrictions based on simply the type of legal entity under which you are doing business, but instead to focus these special rules on plans that benefit the owners, irrespective of whether it's a corporation, partnership, or self-employed individual. So under the top-heavy rules, we have minimum benefit accruals or minimum contribution requirements in DC plans, faster vesting schedules, we had a limit on compensation, and lower 415 limits for combined plans. Now, over time, the last 40 years, much of those top-heavy rules have been made the minimum rules for all plans, irrespective of being top-heavy. So the only thing that really remains today are the minimum accrual or contribution rules and faster vesting for DB plans, which begs, why do we still have these rules? The minimum accrual rules are also misplaced. In the old days, people may remember you could have a integrated only plan, which provided no benefits on for contributions made on compensation below the taxable wage base. And we did away with those rules as well. So we really don't need top heavy, but unfortunately the politics are such it's unlikely that they're going to be repealed anytime soon. TEFRA also, a lot of it was a Democratic bill mostly, and there were efforts to rein in what were perceived abuses in the retirement plan area. One was with loans. When I first broke into the business, it was common for a doctor, as soon as he or she got a couple $100,000 in their profit sharing plan, to borrow $100,000 of it with interest-only payments, and it coming due 20 or 30 years later. Now, the IRS would go in and say, that's not really a loan. That's really a disguised distribution, and you should be taxed on it. The doctor would say, no, it's a real loan, and I've got to pay it back. And the benefit to the doctor was he or she got to use the money now, but didn't have to pay taxes on it till 20, 30 years later when the loan came due, and eventually the money came out of the as a distribution from the plan. Well, Congress, IRS was wasting time and resources fighting these loans as to whether they were or were not legitimate. Congress said, enough already. We're going to put limits on how much you can borrow from a retirement plan. We're going to put a limit on how much you can borrow. We don't want it too large. Generally, the limit is the greater of either the lesser of 50,000. Let me back up. The loan, that it's too large. It can't be any greater than the lesser of $50,000 or 1/2 your vested account balance. I'm not sure I phrased that well on there on the bullet point, but it can't be any greater than the lesser of 50,000 or one-half the vested account balance, and it can't be too long. Generally 5 years, though we know for home acquisition loans it can be longer. And Congress didn't mess around. It made this new limit applicable to any loan made after August 13th of 82, which was the date of enactment of TEFRA. It also lowered the 415 limit so you could put less money in. It made withholding on planned distributions mandatory, though it did give a participant the right to elect no withholding. That's since gone away. And it placed a 100,000 limit on the amount of retirement benefits that could be excluded from your estate for estate tax purposes. And those three items were all aimed at raising revenue. And so that was TEFRA, and then we got to DEFRA. And again, it's noteworthy that there was a time when Congress actually seemed to care about deficits. And what DEFRA did was the 415 cutbacks were supposed to begin increasing with cost of living adjustments. Congress cut that back. They did away entirely with any kind of estate tax exclusion for retirement death benefits. And it placed new restrictions on VEBAs, which we really don't get into much these days, at least from retirement plan side of things. And then we had the Retirement Equity Act of 1984, and REA was intended to provide more equitable treatment for women under the pension laws. And I know I very much appreciate that REA applies to both men and women, but back in the 80s, there was more traditional concern that men were working and stealing the pension, if you will, maybe not stealing, but getting the benefit of a pension without having to provide it necessarily to their spouse. So it added what we have today, the qualified joint survivor annuity rules, as well as the qualified pre-retirement survivor annuity rules. We got quadro procedures embedded into law, and we got rules to allow parents to take a break from work without having, as a result of maternity or paternity of birth, to take a break without having a break in service under the retirement laws. In addition, though, REA also, those were the primary protections for spouses, but it also lowered the maximum eligibility age to 21. There's been some talk of lowering that again to 18 recently. That's not the law yet. It added the immediately distributable rules whereby a plan could not force a cash out on an individual whose account balance or value of his or her accrued benefit was more than $3,500. Now that limit was recently increased to $7,000 as part of Secure 2.0, but it obviously would be even much higher if it had been subject to a COLA adjustment. And then we added, or REA added, Congress added anti-cutback protection for early retirement subsidies as well as for optional forms of benefit. And one of the first articles I ever wrote for a journal was on the 411D6 regulations with regard to optional forms of benefit. Boy, those were good times. And TRA 86. And keep in mind, I got out of the LLM school in 81 and started playing in this area, and it was like 82, 84, 86. And 86 was the granddaddy of tax bills. It literally rewrote the tax code so that today's tax code is cited as the Internal Revenue Code of 1986, and it was adopted as part of Ronald Reagan's initiative to simplify the tax laws and lower the tax rates. But TRA 86, as we affectionately refer to it, made many changes to our pension laws that are still very much part of the qualification requirements today. Under ERISA, and continuing forward, the Internal Revenue Code and to some degree the labor laws have a number of requirements that are intended to ensure that a plan is fair, that it doesn't benefit the big kahunas, the owners and the high-paid employees at the expense, if you will, of the rank and file. And those requirements are largely found in coverage testing and non-discrimination testing under Code Section 40184. But prior to TR 86, much of fairness testing was very subjective, very squishy, and depends on the facts and circumstances. Are you covering a fair cross-section of your workforce? And excuse me, there were court cases fought over that. Once again, Congress kind of steps in and says, enough already. We want this testing apparatus for fairness to be based on more objective testing and less on the squeamish words that you're not quite sure what exactly it means. At the height of that, the most important element was redefining the group of people in whose favor the plan cannot discriminate. In other words, who are now the big kahunas that we can't favor over everybody else? Under the prior to the 86 Tax Act standard, it was, I quoted on your screen, that group were made up of employees who are officers, shareholders, or highly compensated. Now, you'd say, well, that sounds pretty objective. Well, yes and no. In particular, highly compensated wasn't a specific dollar amount like we have today, but rather it was a relative term based upon the workforce. Somebody who is working in a company where the overall payroll is very low might be highly compensated, making $70,000 a year, whereas a company with a more highly paid workforce, that threshold would be more like $200,000. And again, that's kind of where the IRS found themselves in court. There was also some belief that family member groups were unfairly benefiting in a plan. And so for the first time in 86, we were given the very hated rules on family member aggregation, affectionately referred to as family member aggravation for the years we had to deal with that. If you were there, you remember how aggravating it was. Also, under the objectifying of fairness testing, the regs were rewritten so that the test was based upon the percentage of non-Highleys benefiting as compared to the percentage of Highleys benefiting. The idea that you're covering a fair cross-section went out. It lives on to some degree as part of the new average benefits test for cross-testing, but even there, it's got very objective components that you apply to determine whether you meet that test. Also part of TR 86 were concerns about doctors setting up plans that they tested together with a DC plan, and the doctor got a great minimum defined benefit and nobody else got it. We added the new minimum participation rules, and these changes were enacted in 86, but we were given some time to prepare for the much changing landscape that they brought us. TR 86 did away with the Social Security integration and instead gave us the permitted disparity rule. I'm sure very few people remember the integration rules of Rev Rule 81202, but just in case, go find it. It's a good read. The 1/3, 2/3 test was replaced by, again, now we have a very objective determination of who's a big kahuna and who's rank and file. We added matching or the 401M test to police, if you will, and limit the amount the Highleys can get through matching and after tax contributions. But one bit of good news in the 86 Tax Act was, for the first time, a 401k plan that failed an ADP test could fix it by paying money out to the HCEs. And that was, frankly, a big improvement that drove a lot of the adoption of 401k plans that we've seen over the last 30, 40 years. That corrective distribution option was a big and important change. In addition, we got faster vesting schedules, making top-heavy meaningless, at least for DC plans. We got a 401A7 comp limit on all plans, not just top-heavy. Again, why do we need top-heavy rules? I'm repeating myself. For a time, and it was enacted as part of the 86 Tax Act, we had, oh no, excuse me, I'm thinking of a different rule. We do still have an excise tax when a DB plan terminates and there is a reversion to the plan sponsor. Congress thought that was a tax dodge. Frankly, putting that excise tax is one of the first nails that began to put in the coffin of DB plans, but that people lament today. Well, part of it is how the laws have changed over the years, and that was one of them. There are a bunch of ESOP changes, and then the early distribution excise tax under Code Section 72T, normally applicable if the recipient is under 59 and a half. That was an IRA only rule up until the 86 Tax Act. And now it's part of our common dealings in the law, and we've seen, obviously, Secure 1.0 and 2.0 have given us a plethora of new exceptions for certain distributions that meet policy goals. And believe it or not, Tri-86 was the first time that we got an independent limit on the amount of elective deferrals that an employee could contribute to a 401k plan. 402G was born. So that was the 80s, and that took us into the 90s. But the 90s, in many respects, was finishing up the work of the 86 Tax Act, in particular with regard to regulations implementing these statutory changes. And so we got a vast array of new regulations under Code Section 401A4, non-discrimination, the new comp limit under A17, the minimum participation rules under A26, and the new coverage rules under 410B. Now, the law changes were effective in '89 plan year, but the regs gave us time to comply with the regs, and so they became effective in '92, the plan year, and thereafter. Of particular import was the Reg Section 1.401A4, which, interestingly, for the first time in an actual regulation, provided detailed and comprehensive objective methods to test and demonstrate compliance by testing a DC plan on the basis of the benefits it would be projected to provide at retirement, or vice versa, testing a DB plan on the basis of the value of the accruals as a contribution made today. And from that was born the concept of new comparability. And it was a little slow in the pickup at first, but I still remember Howie Phillips. I'm not sure how many people remember Howie, but I do. And at an ASPA conference around 1990, I can't be certain which year it was, I still remember him walking. They used to have a general discussion session, general session. Anybody was free to get up and take the mic and talk. And Howie got up. He was very well respected, and he started putting out the idea, well, what if we took a profit sharing plan and used these regs and turned it into a benefit? And lo and behold, we realized by doing so, older employees, whether they're highly or non-highly, are going to get higher contribution rates than younger employees, and often that was the desire of the plan sponsor as far as plan design. So new comparability was great. We massaged those rules over the year. The IRS did go after them at one point in time. And I was exchanging emails with a person who was in the Treasury Department earlier today, and we talked about the fact that it was in the I guess around 2000 that we reached, if you will, a compromise with the IRS. They were concerned that the new comparability plans were really too good and that some minimum benefit needed to be provided. And from that work was grown the concept of the gateway test. And that person I'm referring to is Mark Every. I think he was Benefits Tax Counsel at the time, later was a senior policy advisor in Treasury for the Obama administration. And those were the good old days when it was a lot, seemingly, I shouldn't say that, I've been out of lobbying for 5 years, but those were times when we really did work together to improve the retirement system for the benefit of all. But unfortunately, there were some bad times. The Small Plan Actuarial Audit Program was born in 1989, and it was a national program initiated at the top branches of the IRS to audit small DB pension plans, i.e., those with 1 to 5 participants, which largely were doctors, dentists, lawyers, you know, the crowd. And the IRS had come to the conclusion that these DB plans were abusive tax shelters, not in the strict sense of the defined term, that term didn't exist back then, but that the doctor and lawyer plans were being too conservative in the interest rate they assumed contributions would earn between the date they went in and normal retirement. They were meaning, therefore, you had to put in more now because you're not going to make as much interest. Well, the IRS said, no, you should have a higher interest rate. They also said you're assuming people are going to retire too young. That's not a realistic retirement age. We're going to go in and fight you on that, because if you have less years to accumulate the contributions, again, you need to put more in now than you would otherwise. And so this was a time when ASPA really got its wind in as far as government affairs work that really was born from some of these early interactions. We had ASPA members who were threatened with malpractice claims. And so ASPA got very much involved in investigating what was going on, and it appeared through their work that this originated in the audit branch of the IRS, not in the actuarial branch. The auditors took a one-size-fits-all approach and insisted in all cases you had to use an 8% interest rate and a retirement age assumption of 65. Since law firms were among those targeted, many of the law firms said, "The heck with you, we'll see you in tax court." And so those cases wound through tax court. At the same time, ASPA, through a Freedom of Information Act request, was able to uncover an IRS budget document that indicated they expected to make $800 million in tax revenue through this audit program, which would have meant 85% of the plans audited would have been rejected, which is a little higher than normal. And so that gave ASPA grounds to both fight it at the IRS as well as in Congress. ASPA had numerous meetings with the IRS. John Burke was the then Assistant Commissioner for Employee Plans Exempt Organizations. And some inroads were made. He did some investigating, and at the ASPA LA Benefits Conference in '91, I was not there, but I've been told, and I think this was in the ASPA history book, that he agreed the IRS had made mistakes. Its agents were not as experienced in examining pensions. In response, they were putting actuaries in 7 district offices to deal with the more complicated nature of these cases. At the same time, there were talks between ASPA. At that time, it was Fred Reich, who many of you know is still with us, and Pat Burns, may he rest in peace, was then ASPA president. They met with John Burke, and those discussions led to a mutually beneficial program called the Actuarial Resolution Program, which allowed many of these audits, DB small plan audits, to be closed relatively cheaply. I mean, everything's relative, but it got those cases settled, and we all moved on. But the silver lining was the IRS saw the benefit of having such a type of resolution program. And so from that, we see first the audit closing agreement program, which is still with us as audit cap, where if you get audited, the IRS will seek to reach a compromise whereby you pay some portion of what the IRS could have collected in back taxes, but by doing so, you avoid the plan being disqualified. But that led to the administrative policy regarding sanctions, which was sort of a wrist slap approach for an auditor who found a disqualifying defect, but it really wasn't that big a deal. And if it was insignificant, the plan sponsor could correct it without having to pay any sanction. Well, the IRS said, this is good. How can we do better? Well, how about if we let people who have problems turn themselves in? And if they turn themselves in, it'd be like EPCRS. We won't charge them a sanction, just a user fee to come in. And these programs became very popular. As all of us know, it's very easy for a plan sponsor to run afoul of the qualification requirements. So it didn't stop there. Then we went to the walk-in closing agreement for people who didn't qualify under the VCR program. EPCRS was replaced with the EPCRS, the Administrative Policy Regarding Self-Correction, which was the initial iteration of EPCRS, if you will. And 2 years later, in fact, we got EPCRS that combined all of these programs into what we affectionately call the Employee Plans Compliance Resolution System. The first iteration was in RevProc 9822. The latest is in RevProc 2021-30. We expect one out soon. The IRS said soon, but when they say soon, it's sort of in the relative sense, like geological time. Soon can mean many years, but it hopefully will be out before the end of this year. And it will include many of the very beneficial changes that were made in the EPCRS area by Secure 2.0. In the 90s, we had UCA, the Unemployment Compensation Amendments Act. It added direct rollover rules, so we'd have less leakage. It restricted some of the rollover constraints from one plan to another. It made 20% withholding mandatory. There's no participant election if you are eligible to roll it over. And then we had OBRA 93. And the only thing worth mentioning in OBRA 93 is not a good thing. It dropped the comp limit, which had risen from the original, I think, 150,000 through COLA and one kick by statute to $235,840. And that number, if you ever ask me what does that number mean, I will tell you that was the comp limit before OBRA 93 dropped it to 150,000. And I'd say where's the comp limit now? Early low 300s. Think of where if we had 20 years of COLAs on that 235,840 figure, where we would be today with that. GUST was 4 different laws. Again, these were wound into a single restatement period, so are often referred together. The GAT was its primary impact was on DB funding rules, requiring increased funding, and there were some technical changes to COLA adjustments. USERRA had a bunch of changes to protect employees who are serving in the military. And then SPIJBA, yes, SPIJBA, the Small Business Job Protection Act. And keep in mind, it is, look at the bottom line. It is the Small Business Job Protection Act. That's not a typo. It protected one job, the small business job, not jobs. In any case, SPIJBA, as we affectionately call it, gave tax exempts, once again, the ability to sponsor a K plan. And then it added some nice things. It allowed prior ADP, ACP testing, which, though well-intended, I don't think many people use. It changed the methodology by which we make corrective distributions, giving the corrections to the HCE with the highest dollar amount of contributions as opposed to the highest percentage. But it added safe harbor plans, and that was in '96, and look how popular safe harbor plans have become today. So, and it allowed simple plans, and it allowed for the first time disaggregated testing for ADP and ACP testing, where you could separately test the otherwise excludable employees from everybody else, which was intended to encourage employers to let these people in sooner rather than later if they're not. One of the complaints was always they're going to hurt our ADP test. It got rid of family member aggravation, hip hip hooray. It made the HCE definition a little easier. It repealed, we used to have a combined limit. If you had both a DB and DC plan, there was a convoluted methodology under Code Section 415E that made you apply an aggregate limit combining benefits and accruals. Now, President Clinton, in his budget proposal, which included this change, said one of the reasons it was included is because nobody got it right. And I don't disagree, nobody got it right. But if that's what it takes to get some things repealed, let me show you, I've got a list off camera here I can give the current administration, but I digress. And the minimum par rules were modified to only apply to DB plans, which is really where they were intended from the first place. TRA 97 increased the cash out limit from $3,500 to $5,000. That was 97, 24 years ago. We just now got it up to $7,000 over 24 years, and it's still not subject to cost of living adjustments. So it's going to stick there. And it will literally take another act of Congress to increase it, but at least it's a little higher. I forgot to mention, but I think it was TRA 86, added a new excise tax on excess accumulations and excess distributions from retirement plans if you had too much in it. There was a 15% tax on the too much, or the too much distributed. And that was repealed. Thankfully, there is every now and then some talk of something similar coming back, but so far so good. It also eliminated the idea that if you're a self-employed employee person, your matching contributions are really elective deferrals because they flow through to you as a deduction on your personal tax return. Congress said that's silly. Yes, that happens, but we should not preclude self-employed from getting matching contributions. And lastly, many of you do not remember the good old days when you had to send in your SPDs to the Department of Labor. I always used to laugh, where do they store those? Are they in the basement of the DOL building on, where is it on? Pennsylvania Avenue, I think. It's on, and the answer is I don't know, but they're gone now. So that was the 90s. Now we made it through the new millennium. The world didn't come to an end on January 1st, 2000. Computers kept working, and what we got was EDTRA, the Economic Growth and Tax Relief and Reconciliation Act of 2001. EDTRA. This was the George W. Bush tax cut vehicle, the first President Bush. The main goal was to lower tax rates, but it made a number of very beneficial changes to the pension laws. And as enacted, EDTRA, it's kind of like the tax cut from 2017. It was slated to sunset in 2011. Thankfully, back in 2006, ASPA and others were able to make it permanent, so it didn't expire. in 2011, and will remain to be seen what's going to happen with the 27 tax cut bill when much of it expires in 2025. Or excuse me, at the end of 2025. ETRA increased the 402G limit, added catch-up contributions. Hard to believe we didn't have catch-up till then. And it increased the 401A17 limit. Again, it had been stuck at 150, it bumped it up to 200, and then COLA thereafter, which, you know, it's, as I say, it would have been a lot higher, but bumping it to 200,000, it's, as my father would say to me, Craig, it's better than a stick in the eye. And as I'm fond of pointing out, I never told my father this, but what's not better than a stick in the eye, I guess. Moving on, forfeiting limits were increased. The annual benefit limit was for DB plans was no longer reduced for retirement between 65 and 62, and the DC contribution limit was increased to 40,000 and indexed by $1,000 increments for cost of living adjustments thereafter. So, I mean, these are beneficial changes. Increase the deduction limit to 25% of comp for a profit sharing contribution and allowed 401k elective deferrals to be deductible on top of that. And for those who were there at the time, you remember that resulted in the death of money purchase pension plans, because before ETRA, in order to get up to your 25% 415 limit of compensation in a DC plan, you needed a 15% of pay profit sharing and a 10% mandatory contribution money purchase plan. Well, with the ETRA change, it could all be discretionary. You didn't need two plans, and hence we see very few money purchase pension plans, certainly very few new ones, and frankly, most of the old ones have been terminated and gone away as well. The changes became effective in 2002 for 401k plans that got rid of the multiple use test, where we had to have look at the a combined limit taking into account both your elective deferral ADP test results and your ACP matching contribution results. It replaced the same desk rule with the severance from employment standard for purposes of being eligible for distribution from your elective deferral or other restricted account. So we no longer had to worry whether the employee was still doing the same job just for a different employer. Now what matters, are you working for a different employer even if you're doing the same job? We reduced the suspension period for hardship withdrawals to 6 months from 12. Top-heavy vesting was then made mandatory for matching. And the Roth after-tax contribution option was added effective in 2006. Top-heavy, these are a litany of good news. Matching contributions can now be used to satisfy top-heavy minimum. And a very popular plan design to this day was born, i.e. a safe harbor plan where the only contributions are elective deferrals, a safe harbor contribution, and or a safe harbor contribution, and potentially matching contributions that are designed to fit within the safe harbor from ACP testing. So you don't match above 6. Matching rate doesn't increase as the deferral rate increases, yada, yada, yada. If those are the only contributions to the safe harbor plan, no top-heavy minimum. And that design has sold like hotcakes in the small plan market. I'm sure many of you have seen the same thing. ETRA facilitated rollovers between different types of plans, required involuntary cash outs in excess of $1,000 to be directly transferred to an IRA rather than leaked into the never land of a distribution where the participant had to do his or her own rollover. And I know I mentioned Mark Every. He was a big proponent of that and fought hard for that as part of ETRA. So many of us were Again, many informed folks have been concerned, continue to be concerned about leakage. That was one of the early steps to try and stem some of that. And then we had the Pension Protection Act. I've already mentioned its most redeeming feature was it made the tax law, pension law changes in EDTRA permanent instead of sunsetting in 2011. But also noteworthy, look how far we've come in 30 years, 32 years, from 74 to 206. We have a woman, that's Blanche Lincoln, in the back. And I've got to add, when I first found this picture, I didn't realize that it was cropped. I've since come to realize there are two women there. If you look very closely, you'll see Elaine Chow's hand coming in from the left side of the picture. Elaine Chow, wife of Senator Mitch McConnell, was serving as Secretary of the Department of Labor at the time PPA 06 was enacted. So, and obviously we've come a long way further since the 06 Act. I've already talked about all the rules that were in ETRA. These would have been sunsetted. Thank God they did not. We have them still today. But in addition, it added codified in the statute protections and improvements with regard to automatic enrollment. Now, PPA was the first time it found its way into law, but Mr. Mark reminded me that it was back in the 90s when he was Benefits Tax Counsel that the IRS, and it was with meetings with ASPA and others, realized that automatic enrollment's a good thing and should be encouraged. So it goes back to a revenue ruling in 98. I think it was 98 or 91, excuse me, in 91, I think was the earliest aspects of this. And then there were further changes along the way. Long story short, what we had automatic enrollment. What PPA 06 did was address some of the plan sponsor concerns. There was concern that state anti-garnishment laws that say you can't take money out of an employee's paycheck without their consent would apply to automatic enrollment. Congress said, nope, ERISA supersedes that, preempts it. It allowed for an EACA, which would be the first time a plan, if a participant auto-enrolled realizes he or she didn't want to be in the plan, that participant can request the money to be paid out, and it can be paid out. If done so, if the request for the return is within 90 days of the first erroneous default. I shouldn't say erroneous. It's one that doesn't have to be erroneous. It's just it was automatically withheld. And it also added more time to distribute for eligible automatic contribution arrangements, giving a sort of a carrot to go with automatic enrollment. And it also added the new automatic enrollment safe harbor, as we fondly call it, the QACA safe harbor. In 2010, we had the DOL. Noteworthy is the fiduciary reg. It started in 2010. It was finalized in the closing months of the Obama administration. It was invalidated in 2018 by the Fifth Circuit Court of Appeals. The Trump administration chose not to appeal. And so it died on the vine. But since that time, the DOL has put out an entirely new set of regs that was slated to become effective, I believe, last week, but has been stayed as a legal challenges proceeding with regard to the newest regulation. So don't hold your breath on when that may become law. But in addition, DOL embarked in the 2009 to the 2010s on the fee transparency. It began with Schedule C, where plan sponsors had to provide more detailed reporting on the fees and compensation being paid to service providers, including indirect compensation. It finalized the regs for the disclosure with regard to investment fees and investment history with on the plan designated investment alternatives. So it applies to plans with directed investments. And then in 2012, it made covered service providers be more transparent in the services it was providing and the fees it was charging with the 408B2 disclosures. And in 2012, there was to the 401k system. I forgot to get it out of my closet. How many have a Save My 401k piggy bank t-shirt from the 2012 ASPA conference? I've actually got 3, but that's the long story how I ended up with 3. It pays to work there when they find a box of them 5 years later and say, what are we doing with these? And that takes us to the current days. Obviously, 1.0 was a very big event. It was long in coming. It started in 2013 as the SAFE Act. It took 6 years to finally become law, emerging as Secure 1.0. You're well aware of what was in 1.0, so I'll let you read that slide on your own. But that wasn't enough. Just as 1.0 was finding its way from committee to the floor of Congress for a vote, Ben Cardin and Rob Portman introduced the next iteration of pension reform, which took them through 3 years, but ultimately emerged as Secure 2.0 without even bothering to put any words to make the acronym have some meaning. This goes through the litany of how the 3 bills were reconciled. This is where we ended up with the many significant changes made by 2.0. We're obviously still talking about them. They'll be covered in the conferences upcoming during the fall season. So I'm not going to bother going into them, but rather I will close by saying, if you ignore the past, then your future is going to be tough. And so we expect more pension law. There's been a bit of a respite. There's going to be another major tax bill, one way or another, next Congress. Something's going to likely happen. I mean, of course, they could just let the 2017 tax cuts expire, but Congress is not generally inclined to, they like to have issues on which constituents have an interest, and ultimately donors as well have an interest. So if you're not a member of ASPA, I would encourage you to be one. I'm sorry, I can't kick the habit. I was working there for 10 years and have been very heavily involved as a volunteer for many more years than that. They are very good as your voice on Capitol Hill and the regulatory agencies. So I'd recommend them to you. But unfortunately, our time together has drawn to a close. I'm over by about 5 minutes of 50-minute time. So I will close it out. Yvette, take us home, please.
All righty, since there's no questions that came in, we can go ahead and close out. Just a reminder, on your go-to panel, you're going to see the drop-down for handouts where you're going to be able to copy today's presentation in PDF form. If you are not able to see this on your panel or you can't click on it, you can email us and we will send that handout over to you. If you need CE credit, you can be sure to fill out the pop-up survey once this session ends. For any other questions, you can email us webinars@novo401k.com. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Novo 401k Associates. Thank you so much, Craig, and thanks again to everybody for joining us. We hope you have a great day. Bye.
Goodbye, guys.